Thank you for watching, and welcome to our brief video describing the QCP Alpha Sources Fund. We'll look at how the fund was designed, how it is structured, how we manage it, and what investors can expect. When our team at QCP first created the Alpha Sources Fund, we had three primary objectives we wanted to fulfill. The first was that after 2009, we had seen that 98% of the investment industry was wrong and did not see the global financial crisis coming. What we wanted in the fund instead was a true, unbiased diversity of opinion from both inside and outside the investment industry. The second important objective for us when creating the fund was that we wanted to be sure it had the potential to perform no matter what the external market conditions were. This meant designing the fund to be able to profit during bear markets and not just during bull markets. The industry needs you to believe that buy and hold is the only way and market timing never works, but we had seen long-term proof to the contrary. Our third major driver was we wanted the fund to take full advantage of technology. We had seen how investors were increasingly at a disadvantage in the markets against computer algorithms, and we wanted to put some of those technologies fully to work for us on behalf of our clients. So let's take a closer look at a couple of these objectives, and then we'll proceed to look at how the fund is structured and managed. Our team embarked beginning in 2009 on a 3-year process of identifying every possible independent source we could find for specific, profitable, actionable trading signals that could be delivered to us electronically. This was not a search for the best companies to invest in. It was a search for the best trading signals, and we'll explain more on that subject a bit later. What we discovered in our search was an amazing diversity of expertise, everything from trading software designers to mathematicians to aerospace engineers, each providing very specific signals when to buy or sell different assets in different markets. We next applied a series of filters to this large universe of trading signals. We eliminated signals that did not have a long enough trading history, that traded too actively, that didn't correlate well with the other signals we had, and that traded assets we felt were not appropriate for the fund. Once we had identified our very short list of candidate signals, we then applied an array of industry-standard analytical tools that helped us understand the risk-reward characteristics of each particular signal. These are tools like Sharpe ratio, Sortino ratio, Monte Carlo simulations that practitioners in the industry know very well. Essentially what we've done is apply some very traditional analysis techniques to some non-traditional inputs. The last step in our fund construction process was to test the selected trade signals in our real money test environment. This tells us how each signal reacts to changing market conditions and what the real-world characteristics, cost, slippage, and returns are like. One interesting note from this screen from our test environment is that one signal is positioned to profit if the market goes down. Another is positioned exactly opposite, and both are showing a profit. This is because of the point in time they opened their trades, and it highlights the potential of this style of investing. So the fund represents a global resource of diverse, unbiased, and uncorrelated trading signals with a consistent and disciplined process for selection and management, and a testing regime using real funds to determine the integrity and reliability of each signal in real-world conditions. Another major objective we had in constructing the Alpha Sources Fund is that we wanted it to have the potential to profit regardless of market conditions. People sometimes forget that bear markets are opportunities for investors to make money if you're positioned for falling as well as rising markets. Positioning for falling markets might just mean that you step aside when markets decline and then jump back in when they start rising again. This example shows one of our Alpha Sources technical trading signals with actual live returns going back to the year 2000, so 12 years live and counting. The signal indicates when to move out of the market, shown in red, and when to move back in, shown here in green. So actually you're taking substantially less risk than a buy and hold approach and generating a better return. This thin black line is the buy and hold approach, which as you can see was basically flat over these 12 years. But at each of these points, the signal was in cash and simply avoided each of the big declines during this volatile period. Now we don't rely on one signal alone. Quite the contrary, we have more than 20 individual signals that we include in the fund, each operating independently. So what exactly is a technical trading signal? This example may give an illustration. In this case, the signal manager is looking at the stock of Newmont Mining. Now, he doesn't care how the mining industry is doing or whether Newmont is earning any money. He doesn't care what Berlusconi had for lunch or what Ben Bernanke said 5 minutes ago. He's only concerned with the price of the stock and whether it's moving up or down. As you can see, buy and hold again was pointless over this long period, but this signal manager has developed some computer analysis that tells him that each time his technical indicator, shown at the top, hits a certain lower level, which is shown here with these little green circles, Newmont Mining has a high probability of going up, in some cases way up. So in the Alpha Sources Fund, we brought together more than 20 trading signals like this, each operating entirely independently from the others. Each of them sits in cash, and when they identify a trade that meets their criteria, they place the trade, with everything taking place electronically into our fund. We've diversified the fund across the major assets and markets, across trading styles, and we've spent hundreds of man-hours ensuring there is little correlation between the signals, so the fund doesn't become unbalanced. One important aspect is that these each are essentially very short-term investments. The average trade in the portfolio currently lasts just 9.2 days. We think this is interesting because we feel the news cycle and the pace of change in the market has accelerated tremendously. It's increasingly difficult to predict conditions in 4 years or even 4 months. This approach shortens the amount of time you have to be right to just 4 weeks, 4 days, or even 4 hours. Now, from a management point of view, we have each of these trading signals coming into our single fund account. This allows us to a high level of transparency and control of the overall characteristics of the fund. We don't second guess the individual signals because that would defeat the purpose of technical trading, which is to take emotions out of the equation. What we will do is step in and reduce the overall risk of the portfolio during times of particular market stress or if we see the fund is becoming unbalanced. The other active management we do, of course, is the continuous monitoring of the behavior of the individual signals. We have very defined rules in place for the discontinuing of one signal and inclusion of another, and that's an ongoing process for us. So that's an overview of how the fund is constructed and managed. Let's talk for a moment about what investors can expect. Can't show you a long fund track record yet because it's a new fund. But unlike other new funds, every single one of the underlying components has a live, real money audited track record. Some of our signals have 10 years or more of live trading. Most have between 3 and 5 years of live trading. We do set a minimum of 1 year, and then we like to see at least an additional 3 to 5 years of credible backtesting, including out-of-sample data. This chart shows our live monthly results for the last 18 months back to June of 2011. Remember, this is an aggregation of real-world returns. Our target objective is to deliver between 2 to 3% monthly net return of all fees on a consistent basis. We're comfortable with that objective, but obviously we can't predict what the fund's future returns will look like. We hope you've enjoyed this look at what we think is a very unique fund. We'd be glad to answer any questions you might have. Thank you for choosing QCP Partners.